Your insurance company just got downgraded, and most people have absolutely no idea what that means for them. We're talking about a quiet financial earthquake happening behind the scenes while you're just out here paying your premiums like everything is fine. Let's back up and understand what a downgrade actually is, because this isn't just bureaucratic noise. When a rating agency like AM, Best or Standard & Poor's cuts an insurer's grade, they're essentially saying the company's ability to pay future claims has weakened, and that should make every policyholder sit up straight. Think of your insurance company like a restaurant with a health inspection score. When that grade drops from an A to a C, you don't wait to get sick before you start asking questions. The downgrade is the warning sign, and ignoring it is the financial equivalent of ordering the soup anyway. Now, here's where the optimism fades fast, because just a few years ago, many of these insurers were riding high on low interest rate environments, flush with investment income and expansion plans. Fast forward to today's tighter margins, catastrophic weather events, and rising claims costs, and some of those rock-solid balance sheets are looking a lot more like sandcastles at high tide. The psychological damage here is real, because your insurance policy is supposed to be the thing you never have to think about. When that certainty cracks, it doesn't just feel inconvenient, it feels like betrayal. And behavioral economists will tell you that loss of trust in a safety net triggers some of our deepest financial anxieties. Historically, insurer insolvencies aren't apocalyptic rarities between 1969 and 2019. Over 600 property and casualty insurers became insolvent in the United States alone. Each time it happens, the public acts shocked. Yet the pattern of deteriorating capital ratios and reserve shortfalls almost always telegraph the collapse months in advance. Here's what most people don't know. Every state has a guarantee association that acts as a backstop if your insurer fails, covering claims up to a certain limit, usually around $300,000 for property claims, though limits vary by state. This system is the financial world's version of a seatbelt, not a guarantee you walk away unscathed, but a critical layer of protection most policyholders have never even heard of. The biggest misconception is that a downgrade automatically means your claims won't get paid. That's not how this works. And panicking into canceling a policy mid-crisis could leave you completely exposed. What a downgrade actually signals is elevated risk, and your job is to assess that risk calmly and act strategically, not emotionally. So here's the practical playbook. First, check your insurer's current rating on AM. Best or Moody's right now, if they're below a B+, start shopping alternatives immediately without canceling what you have. Second, document everything you own, review your current coverage limits, and make sure you understand exactly what your guarantee association covers in your specific state before any crisis hits. The historical lesson from every major insurer collapse, think Executive Life in 1991 or Frontier Insurance in 2001, is that policyholders who acted early and methodically came out far better, those who waited for certainty that never came. Moderate, decisive action beats paralysis every single time. And discipline here isn't about fear. It's about positioning yourself so the outcome of any scenario is manageable. Think of your insurance portfolio the way a serious investor thinks about position sizing. No single policy should represent your entire financial safety net without a backup layer underneath it. Redundancy isn't paranoia, it's architecture. And the people who survive financial disruptions are almost always the ones who built their protection in layers before they needed it. At the philosophical level, this whole situation is a reminder that financial security is never a destination, it's a practice, a set of habits you maintain even when nothing feels urgent. The irony is that insurance, the one product designed to protect you from uncertainty, carries its own uncertainty. And accepting that with clear eyes is how you actually stay protected. You don't need to predict which insurer collapses next, you just need a system that keeps you covered regardless of what happens. Discipline, diversification, and knowing your state's guarantee limits are worth more than any single perfect policy from any single perfect company. And if you're ready to take the next step in protecting your financial future, whether that's real estate investing, home contracting, work, or finding the right lenders, check out our links in the description below and let us help you get started.